Eicher Motors is the top Nifty gainer today on after registering a net profit of 64% growth in the third quarter. Brokerage is bullish. Citi says third quarter margins were better than expected, while Morgan Stanley says the company gained market share post-launch of the Hunter.
Stocks reacting to quarter three numbers include PI Industries. The stock is up 3.5% odd as revenue grows close to 19%. Torrent Power surges 9% after the third quarter numbers beat estimates.
Bharat Forge down 6% today after the third quarter margins come in below street expectations. Brokerage is cautious. Nomura downgrades the stock to neutral, says it anticipates cyclical slowdown in the traditional business, while Citi has a sell call with a target of 690 rupees.
And stocks reacting to weak quarter three numbers. Techno Electric stock takes a hit after the net profit falls by close to around 73%, while Kitex falls close to around 13%, reacting to its third quarter numbers.
Packaging companies under pressure. Uflex reports flat revenue in the third quarter due to currency devaluation by Egypt. Ester India reports 31% loss in revenues, and Cosmo First 2 reveals a 57% loss in EBITDA amid demand disruptions in the overseas market.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu. Well, Mangalam, we had a bit of a dip this morning.
Yep.
The good news is that lower levels have got defended, and the cues that came in yesterday post-market were very, very encouraging with regard to the buy numbers from the institutions and also the FI setup in the F&O market. The sense you get is there is still some unfinished business at higher levels, but crucial that we hold on to that 17,830 odd mark.
Absolutely. You know, technically speaking as well, we have the 20-day moving average around 17,860 odd, yes, and the 100-day moving average at around that 17,950 odd mark. So we're right in the middle of that zone. Important to, break out of that for further short covering that we will see over and above what we saw already yesterday. So that's as far as the frontline markets are concerned. The good part is that the mid-cap index is outperforming after underperforming yesterday. Let's talk about a couple of numbers that came by. Uniparts India reported a decent third set of third quarter numbers. Actually, it's the first quarterly performance that the company is reporting since its listing. They saw almost a double-digit growth in their revenues. The EBITDA margin increase was something that really stood out in the numbers this time. We have Gurdeep Soni, who's the chairman and managing director of the company, joining in to discuss these earnings in detail. Thanks a lot, Gurdeep, for joining in. While there was a growth year-on-year of almost 10%, there was some softness quarter-on-quarter. Could you explain to us what that softness was all about? And the margins came in closer to 24%. Are these sustainable from here on? So your revenue projection and margins, are they sustainable?
Good morning, and thank you for having me on your show. And yes, the results have been quite fantastic. In fact, I would say because, in fact, we've had a revenue of 1,037 crores for the 9-month period, which is 18% above the previous period. We've had a EBITDA of 243 crores, which is actually 21% over the 9-month period of the previous. And the PAT has come at 159.6 crores. Whereas the EPS is 36 crores.
Gurdeep, we have those numbers. We have those numbers. Those numbers are for the public to view as well. What we want from you is what happens from now. You said revenue is a little over 1,000 crores in the first 9 months. 1,400 crores is the annualized figure. Are you on track to do that? And margins at around 24%. Is that sustainable?
So we are on track for the next quarter also, as we have been in the first for the first 9 months. And the margins, we had a 6.6 crore exceptional one-time gain last quarter. That was from a check we received from the American government for protection of wages, So that pulled up the margins a little bit, but sustainable margins are between 21 to 22%, clearly moving forward.
All right, so 1,400 crores, Mr. Soni, for this year. Sustainable margins of around 21-22%. We get that. A couple of questions here. For FY24, what kind of a revenue growth can you guide us for? Point number one. I'm holding on to that margins of around 22%, or if you want to up that, you can tell me. And also, what about revenues at optimal levels? Given that you're doing around 1,400 crores, next year there'll be some growth. At optimal levels, what is the revenues that you can do with the current gross block?
So for the next year, we are again, our end customers are very positive, because our over 81% of our business is exports to the US and Europe and Japan. Particularly in the US market, our customers are looking at a 12 to 15% growth in this current year. And we are also looking our business to grow 5 to 7 to 8% because of the growth of existing parts. But more importantly, the China Plus One is playing out very well for us. And we are expecting new business that has already come in of about 130 crores over and above our standard business. And we expect an overall growth of about 15 to 16% moving for the next year as well.
So 15 to 16% for the next year. Just roughly, calculating that number, you should be in the vicinity of close to around 1,600 to 1,650 crores for next year, right?
Correct. So
And
there will
if you
be
don't-
some correction I would like to mention over here, because sea freights are coming down and also steel prices are coming down. And in the past, these are pass-through entities. So because these are coming down, we will see a correction because of that, a softness. But that has nothing to do with the effect on our PAT numbers.
So at current reckoning, though, you're guiding for close to around 15% growth, right? At current prices, it'll be around 1,600 crores, very roughly. If steel prices come down, obviously that will come down further.
Steel and sea freight both are, in the process of, in fact, come down, and they're passing through right now.
Got it.
Okay. I just wanted to understand, going forward, your revenue contribution, because from what I look at right now, 36% comes in from PMP. You have adjacent products which account for about 12% of your revenues, and 3-point linkage is 58% of your revenues. But the more margin accretive business is PMP and adjacent products, because I remember the last time, just before the IPO, when you joined us, you said that it's a 25% margin business. So can we expect higher contribution coming in from PMP? Can you give us a sense of what the revenue contribution of the company will look like going forward?
In all fairness, we don't look at our margins from product segmentation. What we do is the way we sell the product, our highest margin, which is about 28%, comes from what we do from sales from our warehouses. And that portion of our business is growing. And then what we do, direct sales from India to overseas customers, gives us an average of about 21% EBITDA margin. So, and we are seeing moving forward that the percentage of sales moving from our warehouse are moving up compared to what they were last year.
So could you give us a sense, what is the contribution right now coming in from warehouses, and how much do they going forward?
So the warehouse model contributed 41% last year. In the first 9 months, it contributed about 43%. And a lot of the new business that we are acquiring is primarily going to go through the warehouse model.
Okay, all right. Mr. Soni, you're going to be spending 45 crores, right, in terms of CapEx. What is the asset turn on that? What kind of revenue will you get?
So we have already in the first 9 months spent 23 crores, and we are on target to spend another about 15 crores in the current year. So that's what we're looking at. And we have seen that for every one dollar of capex that we do, our revenue goes up by 8 times.
By 8 times. All right. So from this capex that you've incurred this year, you could realize another 300 to 350 crores.
Correct. So the capex is done, when I say that we've already done 23 crores, that's already contributing to some of the revenue growth of the current year. And then, of course, the balance will come into the next financial year.
So, Soni, at current prices, given that this year you'll do 1,400 crores, next year you should do in the vicinity of around 1,600 crores at current steel prices, as well as freight cost. Your optimal potential of revenue is what?
So we are running at about 81% capacity right now, and I think that's what we are going to be running at moving forward because of the way the business is.
Good speaking to you, Mr. Soni. Thanks so much for stopping by and giving us a sense in business. One would think that the globe is slowing down, so maybe having a higher proportion of export revenue would be a risk. But you're saying that your business is sounding good, your customers as well are sounding extremely confident. So we wish you well, and we look forward to chatting up with you at the end of next quarter. For the time being, let's move on. Let's just focus our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta of moneycontrol.com joins us to talk about a stock that is tracking very closely. Jitendra?
Hi, thanks. With the revival of capex cycle and strong focus on railways, I think KEC International is best placed to leverage its execution capabilities. Recovery, both in the public and private capex, would benefit significantly. It has seen a spurt in order book in the first 9 months of the current fiscal. The company has bagged orders of worth rupees 15,554 crore, which is up 10% on a year-on-year basis. In the current fiscal, it is expecting to win close to 19 to 20,000 crore orders compared to last year order intake of merely about 17,000 crore. Its current order book, which is at 28,000, 29,000 crore, provides a very good or healthy visibility as far as revenue is concerned. And moreover, the company indicated that the project tender line pipeline is almost 1.1 lakh crore, provide a very strong revenue visibility for the next 3 to 4 years. This overall means a stock which has corrected recently from about 525 a share in mid-January to currently 473 a share. It provides a good opportunity in terms of valuations as well. If you look at the company is trading 16 times its fiscal 24 estimated earnings, and which is quite cheap considering a strong order book, improving balance sheet and a strong earning visibility for the next 2 years.
All right, with that, we'll step to a short break. On the other side, we'll be joined by Gopal Krishnan, who's the Executive Director and Group Financial Officer, Group CFO of Shriram Properties, to discuss the company's third quarter performance. Welcome back. Just keep an eye out on Apollo Hospitals. The stock has now moved to the high point of trade. We had the management join us today, and they said that, they are on track to achieve the GMV target for Apollo Healthco. At the same time, they are expecting 100 basis points improvement in their margins as well. So as a result of which, we are seeing an improvement in the stock price at the high point of trade. Of course, the conference call today is at 2. But we have Shriram Properties that reported a decent set of third quarter numbers. The company saw sales volume grow up by almost 3% at a little over 1 million square feet. They also saw their sales value go by almost 39% as we speak. And we do have with us Gopal Krishnan, who's the Executive Director and Group Chief Financial Officer of the company. Thanks a lot for joining in. You had said that 2 projects of yours got deferred to the fourth quarter, and therefore third quarter on a reported basis perhaps not as strong. How much better will Q4 be than Q3? And with that, what's your target for this year?
Yeah, good morning, good afternoon, everyone. So we had a couple of projects got pushed from December proposed launches to January, February, and I think they are on track now. We already launched one of them. We are pre-marketing second project, and 2 more projects are lined up. In addition, we have 2 more launches for Q4. So in all, we have about 6 launches for Q4, and interest so far looks very exciting and interesting for us. So I think, and also Q4 is traditionally a very strong quarter for us. And therefore, we see a very strong number compared to what we have reported over the last several quarters on a quarterly run rate of 1 million square feet per quarter. I think we'll far, far exceed that number in Q4 as we see. For the full year, I think we'll end with, we had set ourselves a target of anywhere between 4.2 million square feet to 4.5 million square feet. And we believe we are on track to reach our expected numbers.
All right. Congratulations, sir. On track to achieve guidance is always heartening. What about FY24? How is that shaping up? If you could tell us what's the million square feet you're looking at selling for the next year? And how do you see realizations pan out from here on?
So we have a very strong pipeline of projects as we have highlighted in the presentation put out on the stock exchanges. We have about 53-54 million square feet of pipeline. 23 million square feet are ongoing, of which 21 million square feet belong to us, and about 3 million square feet belongs to the landowner share. Out of the 21 million square feet, we have sold about 18-19 million square feet already. So we don't have an inventory, significant inventory in our ongoing project. We have about 10-15% of the projects to be sold. And therefore, we are focusing on new launches. Very robust pipeline, about 30 million square feet of pipeline that we have. And that should fuel at least a 20% CAGR in our volume for the next 2 years. and that will be backed by all of these new launches that are coming up. So we remain confident of delivering 20% growth in volumes. From a value perspective, as you would have seen, Q3 as well as 9 months, we had a very robust growth in sales value, around 35-36% for the quarter, and about over 40% for the 9-month period. That's primarily because we it changed the product mix. Last year, this time, we sold mostly on the plot side. So we had plots accounting for almost 26-27% of our sales volume. This time, the share of plots have come down. So constructed units obviously have higher realization. And that has fueled over 30% growth in sales value for the quarter and over 40+% growth in 9-month period. But from a unit realization perspective, if you look at, I think we're doing reasonably well, and I think the market's also doing well. Overall, at the product basket level, our average realization is higher by about 7% for the first 9 months. This is on top of an 8% average realization growth that we saw in second half of FY22. So together in about 12 to 18 months, we have managed to get about 15% higher realization for on a comparable basis.
All right. Is there any scope for further price hikes? I mean, you've taken 6% in Bengaluru, 15% in Chennai, 13% in Kolkata. Raw materials are now coming down. The cost of home ownership is increasing with rise in interest rates. That's point number one, as far as the sales is concerned. And the second point, on your own funding, is your cost of borrowing increasing? I mean, what's your proportion of borrowing from the Shriram Group right now? Last time you said that you had seen a bit of a decrease in the borrowing rate. So from both the sales end and the fundraising end, can you give us a sense?
Yeah, based on what we learned from our own understanding of the market as well as from the home loan lenders, the momentum has not come down, notwithstanding the rate hikes that I've seen. It is not yet. I think it does not. It's unlikely to have a material dent unless the rates keep moving up, maybe to a double-digit retail loan level. But as of now, I think the underlying demand seems strong, and the positive undercurrent is supporting volume growth and pricing growth for most players, and I can speak confidently for Shriram Properties. From a cost of funding, cost of debt perspective, we have actually gone down the cost curve. To clarify, we don't borrow anything from Shriram Group. You mentioned about Shriram Group. We don't borrow anything from the Shriram Group. We actually borrow from the market. We shifted from NBFC bucket to bank loans for construction finance, and that has helped us in bring down the cost of debt. Our cost of debt, speak in December, is around 12.5% for the company as a whole. And this is despite the 1.9 or 2% increase in RBI rates. And that means about 10.5% of effective rate as compared to where it was on an April 2022 basis. In April or the year end last fiscal, we ended with about 14% cost of borrowing. So we effectively have come down meaningfully in the last 9 months, and that's very encouraging for us.
Well, I appreciate you stopping by, sir, and giving us all those details as well as numbers. Wishing you all the best for the coming quarter. As you said, Q4 is a rock-solid one, and FY24 as well, you're sounding fairly optimistic. We look forward to having a chat with you, and it appears that the real estate market is really picking up big time. For the time being, we'll slip in a short break. On the other side, we'll continue to focus on markets and stock-specific action. Welcome back. Well, the markets are more or less flattish with a mild negative bias, but just keep an eye out on the broader markets. A couple of stocks are moving very, very well. India Pulse Housing Finance started the day on the back foot. Well, that's moved to the high point of the day. City Union Bank, it got a hard knock a couple of sessions ago. Now, that's moved higher as well. And a couple of other names as well. REC has moved up in the last couple of minutes. So there is some traction in the broader markets. We made this point earlier today. If the Nifty can just hold itself, maybe the broader markets that have been lagging, even yesterday didn't participate, it could come to the party, and that appears that that's precisely what's happened. But we've run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.